This report by the IMF, or to give them their full title, the International Monetary Fund, found that interest rates will return to their ultra-low levels once inflation comes under control, which could help bring things back to some level of normality. Which could mean good news for homeowners who are faced with crippling mortgage costs, who have been hit hard by the recent rise in inflation. But while a pack of Lurpak currently costs £7.25, it certainly doesn't feel like it at the moment. With us recently passing a 41-year high in October, inflation is still being driven by goods, energy, food and services. And our inflation is much higher than similar economies. But a light at the end of the tunnel is that it is expected to drop quite sharply, both by the Bank of England and the OBR, or the Office for Budget Responsibility. So where has this report come from? Well, the IMF are funded by the United Nations, and part of their job is to research and publish the World Economic Outlook, which can help drive countries' decisions. Now, to truly understand the findings of this most recent report, we need to first understand the difference between nominal, natural and real interest rates. And don't worry, it's nowhere near as complicated as it may sound. First, the nominal interest rate. This is actually by far the simplest one of the three. It's a rate you'll pay on things like your mortgage. When you apply for your mortgage and state how much you want to borrow over what period of time and tell them your deposit, the bank will give you an interest rate they want you to repay in order to loan you the money, which is charged on the outstanding balance each year. So people say they are paying a 4% interest on the mortgage, they actually mean the nominal interest rate, which is set by the bank. This is typically determined by the rate set by the Bank of England. The banks then just maybe add on half a percentage point and work out their rate to make a profit. It's individual to different banks, and many more factors come into play, like the length of the mortgage, whether it's a fixed or variable rate, and if there's any upfront fees and so on. And that's a nominal interest rate. Pretty straightforward. So what about the real interest rate?
Will the real Slim Shady please stand up?
The real interest rate was created by a man called Irving Fisher in the 1930s, and in Economics 101 it's often called the Fisher effect. He worked out an equation which essentially works out the real interest rate, which is the nominal interest rate minus inflation. For an investor's point of view, for a healthy return, it's important that this rate is positive. Just to illustrate this, let's say James wants to buy the top of the line new TV. And this TV cost £1,000. But he doesn't need the TV right away, he can wait till next year. So he decides to put that £1,000 in a savings account currently offering a 4% rate for a fixed 1 year. In 1 year's time, James will have £1,040. But the current rate of inflation is 10%. James goes to withdraw his money and buy his brand new TV, but the TV that cost £1,000 now costs £1,100, and he's £60 short. Why did this happen? Because the real rate of interest is actually 4%. Subtract 10% and you're left with minus 6% interest. This is often why people describe cash interest accounts as being so dangerous, because you aren't even beating inflation. And if that's got you worrying, well, don't. Because the truth is, inflation is often not linear. Although it may not seem like it, everything in the world isn't going up by a fixed 10% price increase year on year. Although food is a pretty drastic example. And while beating cash interest rate by investing sounds appealing, it doesn't always happen. And getting 4% can often be better than getting nothing. In my portfolio, my cash balance actually delivered the best return in the past 12 months, and I'm invested in simple index funds. The other quite interesting thing here is that in times of high inflation, house owners can actually benefit. Now you're probably thinking with a 4% rate it doesn't feel like it, but think of it like this. In simple terms, you have a £300,000 house and you have £200,000 left on your mortgage. Your nominal rate of interest is 4%, so each year you owe £8,000 in interest. But actually, if inflation drives the price of your house up by 30%, a 10% rise, you're actually £22,000 better off despite paying that higher rate. So sometimes inflation isn't as bad for property as it may seem. The real interest rate has actually been improving in 2023 so far, which is good news for the majority of us. And speaking of good news, I have to say a huge thank you to CoinJar for sponsoring this video. CoinJar are my go-to place for buying cryptocurrency, and they're the only provider I use. They're secure, regulated by the Financial Conduct Authority, and you can get your very own crypto card, and they've just improved their reward points store so you can earn points buying and sending crypto and use those points either towards your next fees or to go and get vouchers at stores like John Lewis, Just Eat or Amazon. If you're interested in checking them out, be sure to use my exclusive link down below in the description, which they've given me to give you £10 in free Bitcoin to try them out. Now we've got our head around nominal interest and real interest rates, what the hell is a natural interest rate? Well, this is a rate that is actually the most important to this report. Think of it like the Truman Show. The natural interest rate is the rate that in a perfect world would keep the economy firing on all cylinders, prices under control and the country operating at full employment. This is used as a reference point for banks and governments to see where the economy is at and how feasible things are like getting more debt, which we never like. This rate is actually the most complex of all because it's driven by a range of different factors. The report looked into whether global factors had an impact or if it was more domestic, i.e. coming from the UK. It actually found that despite some global factors having an impact, they are quite low, and that the majority of factors are primarily coming from the UK. An example of a global factor that does drive this growth rate is emerging markets. So in these countries, their savings have grown, but there aren't enough stable assets for the money to be held in. So the majority of it goes into things like bonds in developed countries like the US, or in our case, the UK. In fact, the far more pressing factors are coming from us, and why it becomes so difficult is because it's a complete balancing act. For example, on one side there's an aging population, people are needing to spend more of their money, which drives it down. But on the flip side, the government need to continue support for this aging population and pay out more in pensions. Another example is the short-term impact of fossil fuels being so expensive. Investing in green technology will help bring inflation down and decrease the rate. But on the other side, there needs to be huge government borrowing to help fund this. Another huge factor that can impact this rate is deglobalization, which is quite a controversial topic, which essentially is the path to a less connected world, which sounds a bit backwards. This is bad in some ways because a free flow of trade between countries is good, but it leads to more dependence on other countries. It can be good for an economy in that it can lead to more self-sufficiency and growth within that market. But weirdly, to actually get inflation under control, we want less growth. And this is just a really basic example, so you can imagine why politics is just so complex, because every decision has repercussions and not everybody agrees on what they should be. The report found that natural interest rates could actually fall quite significantly in countries like China and Germany. But when we actually look more specifically at the UK, we can see it's really not moved very much at all, despite the real interest rate dropping so low. What this suggests is that although there's been a real spike in the real interest rates, it's likely to be temporary, and once inflation is brought back under control, the Bank of England will lower its rates and interest rates will start heading back to pre-pandemic levels. Now, how close to those levels we'll have to wait and see, but it's a positive sign nonetheless. When we actually look at the basics of inflation, it's quite simple. As hard as it is to believe, inflation is high when there's just too much money in the economy. Things like an aging population who will be spending more of their pension pots and low growth, i.e. people not making more money, will help bring inflation under control because people will just have less money. Wholesale energy prices have also fallen a lot, although we might not yet feel the impact of it, and import problems are beginning to ease, which should help bring costs of foods and goods down. So you're probably thinking, when's this actually going to happen? Well, the Bank of England is expecting the rate of inflation to fall quickly halfway through this year. A positive sign is they are hoping that the final rate increase will be 4.5%, and they've only been raising it 0.25% recently. They have to play a balancing act themselves between not raising it too much and raising it enough to bring inflation down. The positive thing to take away from this is that at some point interest rates will come back down. Remember, they have been way over 10% in the past. So hopefully those of you terrified that your fixed 2% mortgage is coming to an end may not quite be as bad off as you might think. And you've probably benefited from the recent surge in house prices to help offset it. And remember, you could be much worse off like me, looking to buy a property with increased prices and high interest rates, or not even be able to buy a property at all. If you want to see how I get on with buying a property, be sure to subscribe. And if you haven't already, sign up for my newsletter where I'm able to share more personal behind the scenes info with you guys. And if you haven't seen it yet, you may want to see my latest portfolio update, as I'll have another along the way shortly. Thank you for watching, and I will see you guys over there.